An investor is an individual that puts money into an entity such as a business for a financial return. The main goal of any investor is to minimize risk and maximize return. It is in contrast with a speculator who is willing to invest in a risky asset with the hopes of getting a higher profit. There are many types of investors out there. Some invest in startups hoping that the company will grow and prosper. They are also referred to as venture capitalists. In addition, there are those who put their money into a business in exchange for part ownership in the company. Some also invest in the stock market in return for dividend payments. What is investing? The act of putting money into a business or organization to earn a profit is called investing. With a small business, an investor takes on the additional risk of making little to no profit as the business may or may not succeed. However, with a publicly traded company, there is a wealth of information available on the company's financial position that will allow the investor to make a more calculated decision and enter and exit the market as they please. In the U.S., the Securities Exchange Commission, SEC, regulates the investment risk in publicly traded companies. An investor is any person or other entity, such as a firm or mutual fund, who commits capital with the expectation of receiving financial returns. Investors rely on different financial instruments to earn a rate of return and accomplish important financial objectives like building retirement savings, funding a college education, or merely accumulating additional wealth over time. A wide variety of investment vehicles exist to accomplish goals, including, but not limited to, stocks, bonds, commodities, mutual funds, exchange-traded funds, ETFs, options, futures, foreign exchange, gold, silver, retirement plans, and real estate. Investors can analyze opportunities from different angles, and generally prefer to minimize risk while maximizing returns. Investors typically generate returns by deploying capital as either equity or debt investments. Equity investments entail ownership stakes in the form of company stock that may pay dividends in addition to generating capital gains. Debt investments may be as loans extended to other individuals or firms, or in the form of purchasing bonds issued by governments or corporations which pay interest in the form of coupons. Key takeaways: investors use different financial instruments to earn a rate of return to accomplish financial goals and objectives. Investments include stocks, bonds, mutual funds, derivatives, commodities, and real estate. Investors can be distinguished from traders in that investors take long-term strategic positions in companies or projects. Investors build portfolios either with an active orientation that tries to beat the benchmark index or a passive strategy that attempts to track an index. Investors may also be oriented toward either growth or value strategies. An investor is a person or entity that allocates financial capital with the expectation of a future return, profit, or to gain an advantage, interest. Through this allocated capital, the investor usually purchases some species of property. Types of investments include equity, debt, securities, real estate, infrastructure, currency, commodity, token, derivatives such as put and call options, futures, forwards, etc. This definition makes no distinction between the investors in the primary and secondary markets. That is, someone who provides a business with capital and someone who buys a stock are both investors. An investor who owns stock is a shareholder. Types of investors. There are two types of investors: retail investors and institutional investors. Investors might also be classified according to their profiles. In this respect, an important distinctive investor psychology trait is risk attitude. Investor protection through government. Investor protection through government involves regulations and enforcement by government agencies to ensure that market is fair and fraudulent activities are eliminated. An example of a government agency that protects investors is the U.S. Securities and Exchange Commission, SEC, which works to protect reasonable investors in the United States. Similar protections exist in other countries, including the United Kingdom, where individual investors have certain protections via the Financial Services Compensation Scheme, FSCS. Investment tax structures. Company dividends are paid from net income, which has the tax already deducted. Therefore, shareholders are given some respite with a preferential tax rate of 15% on qualified dividends in the event of the company being domiciled in the United States. Alternatively, in another country having a double taxation treaty with the U.S., accepted by the Internal Revenue Service, IRS. Non-qualified dividends paid by other foreign companies or entities, for example, those receiving income derived from interest on bonds held by a mutual fund, are taxed at the regular and generally higher rate of income tax. When applied to 2013, this is on a sliding scale up to 39.6%, with an additional 3.8% surtax for high-income taxpayers, $200,000 for singles, $250,000 for married couples. Role of the financier. A financier is a person whose primary occupation is either facilitating or directly providing investments to up-and-coming or established companies and businesses, typically involving large sums of money and usually involving private equity and venture capital, mergers and acquisitions, leveraged buyouts, corporate finance, investment banking, or large-scale asset management. A financier makes money through this process when their investment is paid back with interest, from part of the company's equity awarded to them as specified by the business deal, or a financier can generate income through commission, performance, and management fees. A financier can also promote the success of a financed business by allowing the business to take advantage of the financier's reputation. The more experienced and capable the financier is, the more the financier will be able to contribute to the success of the financed entity, and the greater reward the financier will reap. The term, financier, is French, and derives from finance or payment. Financier is someone who handles money. Certain financier avenues require degrees and licenses including venture capitalists, hedge fund managers, trust fund managers, accountants, stockbrokers, financial advisors, or even public treasurers. Personal investing, on the other hand, has no requirements and is open to all using the stock market or by word-of-mouth requests for money. A financier will be a specialized financial intermediary in the sense that it has experience in liquidating the type of firm it is lending to. Perceptions. Economist Edmund Phelps has argued that the financier plays a role in directing capital to investments that governments and social organizations are constrained from playing. The pluralism of experience that the financiers bring to bear in their decisions gives a wide range of entrepreneurial ideas a chance for insightful evaluation. And, importantly, the financier and the entrepreneur do not need the state's or social partners' approval. Nor are they accountable later on to such social bodies if the project goes badly, not even to the financier's investors. So projects that would be too opaque and uncertain for the state or social partners to endorse can be undertaken. The concept of the financier has been distinguished from that of a mere capitalist based on the asserted higher level of judgment required of the financier. However, financiers have also been mocked for their perceived tendency to generate wealth at the expense of others, and without engaging in tangible labor. For example, humorist George Helgeson Fitch described the financier as a man who can make $2 grow for himself where one grew for someone else before. Styles and risk tolerance. Investors are not a uniform bunch. They have varying risk tolerances, capital, styles, preferences, and time frames. For instance, some investors may prefer very low-risk investments that will lead to conservative gains, such as certificates of deposits and certain bond products. Other investors, however, are more inclined to take on additional risk in an attempt to make a larger profit. These investors might invest in currencies, emerging markets, or stocks, all while dealing with the roller coaster of different factors on a daily basis. Institutional investors are organizations such as financial firms or mutual funds that build sizable portfolios in stocks and other financial instruments. Often, they are able to accumulate and pool money from several smaller investors, individuals and/or firms, in order to make larger investments. Because of this, Institutional investors often have far greater market power and influence over the markets than individual retail investors. Passive investors vs. active investors. Investors may also adopt various market strategies. Passive investors tend to buy and hold the components of various market indexes and may optimize their allocation weights to certain asset classes based on rules such as modern portfolio theories, MPT, mean variance optimization. Others may be stock pickers who invest based on fundamental analysis of corporate financial statements and financial ratios. These are active investors. One example of an active approach would be the value investors who seek to purchase stocks with low share prices relative to their book values. Others may seek to invest long-term in growth stocks that may be losing money at the moment but are growing rapidly and hold promise for the future. Passive, indexed investing overtook active investment strategies in 2023 as the dominant stock market logic. Point 1. The growth of low-cost target-date mutual funds, exchange-traded funds, and robo-advisors is partly responsible for this surge in popularity. Those interested in learning more about investing, passive and active investors, and other financial topics may want to consider enrolling in one of the best investing courses currently available. Financial investments have the very specific goal of buying something that, hopefully, appreciates in value. Consider other forms of investing such as returning to school to complete your degree or embarking on a diet to ensure good health in the future. Investors vs. traders. An investor is typically distinct from a trader. An investor puts capital to use for long-term gain, while a trader seeks to generate short-term profits by buying and selling securities over and over again. Investors typically hold positions for years to decades, also called a position trader or buy and hold investor, while traders generally hold positions for shorter periods. Scalp traders, for example, hold positions for as little as a few seconds. Swing traders, on the other hand, seek positions that are held from several days to several weeks. Investors and traders also focus on different types of analysis. Traders typically focus on the technical factors of a stock, known as technical analysis. A trader is concerned with what direction a stock will move in and how to take advantage of that movement. They are not as concerned about whether the value moves up or down. Investors, on the other hand, are more concerned with the long-term prospects of a company, often focusing on its fundamental values. They make investment decisions based on the likelihood of appreciation of a stock's share price. How to become an investor? Many individuals naturally become investors, especially considering those that prioritize long-term savings and putting money away for retirement. Begin by learning the basics of investing, such as the various types of assets, e.g. stocks, bonds, real estate, investment strategies, e.g. value investing, growth investing, and risk management. Early in your investing career, be mindful of your risk tolerance. Though greater returns are often had by taking on greater risk, there is also greater downside or loss of original capital. To invest in stocks, bonds, and other securities, you'll need to open a brokerage account with a reputable broker. To invest in real estate or physical property, you'll want to be well versed in local real estate law. Other specific assets will have specific requirements as well, such as a digital wallet for cryptocurrency or physical protection for bullion or tangible precious metals. Because investing is much different from trading, it's critical to determine your investment goals, such as your target return and time horizon. This will help you choose the right investments, such as a target date fund, and make informed decisions. For example, if your goal is to invest money for retirement, you likely have a much longer horizon compared with an investment goal to purchase a new car in several years. Depending on what you are trying to achieve, you will want to frame your investing strategy around your long-term target. Last, it is important to keep up with market trends and news that may impact your investments. This can help you make informed decisions and adjust your strategy as needed. Depending on your holdings, this may be related to financial, political, international, or social news that may have a ripple effect on the valuation of what you own. What do investors invest in? The basic philosophy of investing is simple: a person contributes capital towards an asset with the expectation that the value of that asset will be higher when it comes time to sell or liquidate the asset. For this reason, an investor can literally invest in anything that may appreciate in value. This is evident by the lucrative deals seen by investors buying and selling tiny rectangles of cardboard, i.e. baseball cards. A more comprehensive list of traditional or common things investors invest in is below. Stocks. Investors can buy shares of publicly traded companies, which represent ownership in the company and provide a share of its profits. Many brokers now allow for partial share ownership, so investors are not necessarily required to own a full share of a company's stock. Bonds. Investors can buy fixed income securities such as government bonds or corporate bonds, which pay interest and return the principal investment at maturity. The risk with bonds is the value of the investment will fluctuate based on prevailing interest rates. Real estate. Investors can buy properties, either directly or through real estate investment trusts, REITs, which provide rental income and may appreciate in value over time. In addition, landlords may collect cash flow from operations for properties being rented. Mutual funds. Investors can invest in a professionally managed portfolio of stocks, bonds, or other assets. The goal behind mutual funds is to have diversification and lower risk compared to investing in individual, specific assets. Exchange-traded funds, ETFs. Investors can invest in a basket of stocks, bonds, or other assets, similar to mutual funds. However, ETFs also have the added benefit of being traded on stock exchanges like individual stocks. Commodities. Investors can invest in physical commodities such as gold, silver, oil, or agricultural products, which may offer protection against inflation and other economic risks. This can be traded as physical items or derivative contracts. Most often, these assets have value because of their real-world use as tangible items. Alternative investments. Investors can invest in alternative assets such as private equity, venture capital, hedge funds, cryptocurrency, art, or collectibles. Though potentially riskier investments, the end goal is always the same: to own something that increases in value over time. What are the three types of investors in a business? The three types of investors in a business are pre-investors, passive investors, and active investors. Pre-investors are those that are not professional investors. These include friends and family that are able to commit a small amount of capital towards your business. Passive investors are those that are professional investors that commit capital but do not play an active role in managing the business. An example would be angel investors. Active investors are those that commit capital but are also actively involved in the business. They make decisions on strategy, senior management, and more. Examples include venture capitalists and private equity firms. How do investors make money? Investors make money in two ways: appreciation and income. Appreciation occurs when an asset increases in value. An investor purchases an asset in the hopes that its value will grow and they can then sell it for more than they bought it for, earning a profit. Income is the regular payment of funds from the purchase of an asset. For example, a bond pays fixed payments at regular intervals. What qualities make a good investor? To be a successful investor, a certain set of skills are required. These include diligence, patience, acquisition of knowledge, risk management, discipline, optimism, and the setting of goals. An investor is an individual or entity that utilizes its capital or the capital of others with the goal of receiving a return. Investors can range from a person buying stocks at home on their online brokerage account to multi-billion-dollar funds investing globally. The end objective is always the same: to seek some return, profit, in order to build wealth. Investors commit their capital to a wide variety of investment vehicles, such as stocks, bonds, real estate, mutual funds, hedge funds, businesses, and commodities. Investors encounter risk when they commit capital, and walk a balance between managing risk and return. Thank you for watching this video.